Hey everyone, welcome. Today we're talking about a massive shift happening in crypto. And it's not being driven by hype or some crazy price pump. No, it's something way more powerful. US regulation.
So this is the main idea we're digging into. A lot of people think of regulation as this big, scary cage for crypto, right? Well, I want you to forget that. Think of it more like this. They're not building a cage. They're building the railroad tracks for a massive, massive train of institutional money that's about to pull into the station.
All right, so we are absolutely moving into a new era for crypto. It's less about the Wild West of retail speculation and a lot more about building a solid institutional foundation. So, let's get into it.
Okay, so the big picture, the macro environment is kind of calming down, which is great. But the real story, the thing you need to pay attention to, is the groundwork being laid by US regulators. Seriously, this isn't just another what's the price today update. This is about a deep structural change. They are literally preparing DeFi and stablecoins to plug right into the traditional financial system. And that means a potential tsunami of liquidity and a whole new level of legitimacy for crypto.
All right, that sounds big, I know. So you're probably asking, where's the proof? What's the hard evidence this is actually happening? Well, let's look at the signals. And these aren't just rumors. They're coming straight from two of the most powerful financial bodies in the US.
First, you've got the CFTC, the Commodity Futures Trading Commission. They just announced this big new thing called the Tokenized Collateral and Stablecoins initiative. This is huge. It's basically them saying, hey, we're focusing on how to use crypto assets as collateral. This is a historic move, you guys. They are actively building a legal bridge to connect crypto's most important parts with traditional finance. Think about that. They're not trying to ban it, they're figuring out how to integrate it.
And get this, just a few days before that, a Fed governor gave a speech about the exact same thing, stablecoins. This is what you call a 1-2 punch of legitimacy. It's not a coincidence. When you have both the CFTC and the Federal Reserve openly talking about building the framework for stablecoins, you know something big is happening under the surface.
Now, this term, tokenized collateral, you're going to hear it a lot. It is so important to get what this means. All it is taking real-world stuff, like bonds or even real estate, and turning them into digital tokens on a blockchain. Why does that matter? Because it's the key that unlocks trillions, and I mean trillions of dollars of real-world value, allowing it to flow into the crypto world in a completely legal and regulated way.
And look, this isn't just some theory or a white paper idea. It's happening right now. BlackRock, that BlackRock, has a tokenized fund called Boodle, and it's already being used as collateral on huge exchanges. This is the smoking gun. It proves the big money, the institutional appetite, isn't just on its way, it's already here, and it's starting to scale up fast.
Okay, so that leads to the million-dollar question, right? Or maybe the trillion-dollar question. When all this institutional money really starts to pour in, where is it going to go? Because these new rules, they don't treat all of crypto the same. They're going to benefit certain ecosystems way more than others.
So you've got Bitcoin on one hand, it's digital gold, the ultimate store of value, the anchor of the whole market. But then you have Ethereum. And this is where it gets really interesting. Ethereum is poised to benefit huge from this specific regulatory shift. Why? Because everything the Fed and CFTC are talking about, DeFi, stablecoins, tokenized assets, that's Ethereum's bread and butter. It's the literal railroad tracks for this new financial system.
So what does this mean for the market? Well, it sets the stage for what we could call a regulatory adjustment rally. Here's how it'll likely play out. First, money will probably flow into the safest bets, Bitcoin and ETH, right? But then, once things settle, we'll start to see that capital rotate. It'll start searching for the next big thing, and that's likely going to be altcoins that are playing by the new rules, especially projects focused on real-world assets, or RWA, and other compliant DeFi protocols.
Okay, so this capital rotation is coming, but how can you actually track it yourself, instead of just waiting to read about it in the news after it's already happened? Let's get into the toolkit.
The good news is, you don't have to guess. You can be proactive. You can literally watch the money moving on the blockchain and keep an eye on a few key market indicators that will signal exactly when this rotation starts to pick up steam.
Indicator number 1, and this is a big one, is Bitcoin dominance. It's super simple. It's just Bitcoin's slice of the total crypto market pie. If you see this percentage start to drop, that's a classic, powerful signal. It means money is moving out of Bitcoin and flowing into altcoins. And that could be the starting gun for an altcoin season led by all these RWA projects we've been talking about.
And if you want something even simpler, there's the Altcoin Season Index. It just gives you one number. Think of it like a weather report for the market. Right now, we're at 32, which means we're still very much in Bitcoin season. But this is the number to watch. If it starts climbing up towards 75, that's your clear sign that altcoin season has arrived and the capital rotation is officially on.
You know, the on-chain data experts at Glassnode put it perfectly. The real truth in this market isn't found in Twitter threads or hype, it's in the actual flow of capital. So, follow the money. The on-chain data shows you what the big institutions are doing, not just what they're saying.
So, the takeaway here is pretty clear. The whole market is being rebuilt, re-equipped for a totally new class of investor. The question isn't if institutional money is coming to DeFi anymore. That ship has sailed. The real question is, where will it land first? Which one of these compliant, real-world asset protocols do you think is going to be the first to catch this massive wave? Thanks for tuning in.